Microphone check. Hello and welcome everybody to Macro Race with your host Tony. We have the US inflation data. Could be a biggie, it might not be a biggie, but either way, we've got a lot to go through. So US CPI. Also, don't forget to share this video with your fellow traders and friends. Of course, this information, if it's useful to you and you like it, don't forget to like the video and share and also subscribe to the channel. But let's get into it. US CPI. So first thing we've got to understand is what is CPI. If you don't know what it is already, it stands for the Consumer Price Index, and it shows how much consumers are paying for goods and services. Also, the way it's measured, you have 26,000 retail outlets and 4,000 housing units in 87 urban areas, and prices are collected on 80,000 different goods and services in the US in those urban areas. You hear an echo. There should not be an echo. It might be, you might have two videos going. I do not hear an echo on my side. Yeah, there shouldn't be an echo. It should all be good. Or you might have to refresh your, or you might be, if you're on the FinancialJuice website and you've played it there and you've got it on YouTube and you've clicked on YouTube video as well at the same time, it might be that. But yeah, there shouldn't be any echo. Okay. All right. So carrying on then. So the key measurements then for the CPI report, you have housing, which makes up the biggest part of the CPI report at 42%. Food and beverages represents about 14%. The guy running the stream on Windows 97 probably, nope, definitely not. It's probably down to your PC, but do have a double check. So transportation at 18%, medical care at 8.5%. And then, of course, you have the core reading as well. So that's food and energy. Then the reason why we look at the month-on-month or the month-on-month is the big release in general that everyone focuses on. It's seasonally adjusted, which is the preferred measure to kind of gauge what's going on in the economy at this point now, without the effects of weather and production cycles, etc. That's why it's quite a key release in itself. Of course, in this hiking cycle, when the Federal Reserve is very attentive and sensitive to inflation changes and what's going on there, then you usually have, then it's also the other bits of data too. So the core data and the year-on-year CPI data that everyone focuses on. So the difference between PCE and CPI, this is very important as to why you have, you might see a big difference between the CPI report and the PCE price index report. So the PC places a lower weight on the price of gasoline and residential rents and focuses on the nation as a whole rather than just focusing on urban areas. So the previous report that we had seen for the CPI report was that all items excluding food and energy index rose 6.6% over the last 12 months. The energy index increased 19.8% for the 12 months ending September, which was a smaller increase than the 23.8% increase for the period ending in August. And the food price index increased 11.2% over the last year. So the key points being is that your food and energy are going to be quite key areas to look for in the report, as those are the two things that have caused us to see these high figures of inflation in the US. But of course, the core reading is also going to be very important too. Excluding the food and energy, is our services or goods, are they seeing a rise? Are still seeing a rise in prices, or are they seeing a little moderation in prices, or are they seeing a significant downturn? Then, if we're looking at how it affects the markets, so usually the dollar tends to strengthen when the economy is growing and when inflation ticks up. That will lead to the central bank taking stronger action or action to raise interest rates, to curtail the first of all, consumer spending in order to try and bring down, and then at some point that will also bring down prices when there's less demand for goods that are very expensive. So that's what happens to the dollar. Usually if you get a higher CPI print, particularly nowadays when everyone's focused on CPI, that if you do get a much higher print with CPI, you would probably see the dollar. You could see the dollar fly. Fly like Mary Poppins on on speed. Stocks. So underlying inflation, the core CPI data. If it rises sharply within a month, it can lead to stocks taking a hit. But same thing, even with the CPI month to month and year on year, if you exclude the core data, if you do see a substantial rise in that, of course, in this current time period, higher rates of inflation could lead to stronger rate hikes from the Federal Reserve, or a continuation of strong rate hikes, which would entail lead to lower stock prices. Of course, if you're a stock trader or if you're a business, you're not going to like higher rates of interest. And then that factors into the short-term reaction, where you see the S&P 500 or the Dow or the NASDAQ taking a significant hit. And I'll show you with the deviations that we have in the past as to how better or higher than expected CPI report has affected the stock market. Bonds, if you get high inflation read, it can lead to high yields in an expansionary environment. And also in this current tightening environment, higher yields are priced in anticipation of higher rates of interest by the central bank. So remember, the central bank has control of the short-term rates, the 3-month, or has a big influence in that area there, or the shorter-term yields or bonds. But then the longer-term bonds are left to the traders. Okay, well, of course, they influence the longer-term end. But of course, you tend to see a bigger reaction on the shorter-term rates compared to the longer-term rates if you do get better than expected or worse than expected or smaller than expected inflation report. So key thing is bond yields can go higher with a higher than expected inflation report overall, and then the bond price, of course, would go lower. If you see inflation ticking down, then of course you're going to see the inverse reaction, where yields see a move towards the downside in anticipation of a smaller rate hike from the Federal Reserve, or less tightening, or maybe a pause at some point. That's not off the books. And then, of course, the bond prices would go higher instead. So, where is the economy at the moment? This is very key, and these measures that we're measuring here will give us a good outline as to where inflation or how strong inflation could be, and whether or not we might see a significant drop or not. So you have the non-farm payrolls figure that we had at 261k versus prior of 263k. There was about a 60k deviation from the forecast figure, which led to the dollar seeing some strength. The unemployment rate ticked up 3.7% compared to 3.5%. So there was a mixed report there. Average earnings is also quite key too when we're talking about wage price spiral, or if there's strong wage prices that will lead to people being able to spend more on the same amount of goods or services. That ticked down 4.7% compared to a prior of 5%. Employment cost at 1.2% versus 1.3%. The PC price index year on year was unchanged at 6.2%. Remember, the PC price index is the preferred measure of inflation for the Federal Reserve when looking at forward guidance. Okay, but of course, if things go awry with the CPI report, then of course they'll be very reactive to that and take action, as they have done in the past when they decided to do a 75 basis point hike instead, because inflation was very sticky. Core CPI reads year on year at 5.1% versus 4.9%. The ISM manufacturing prices paid ticked lower to 46.6 versus prior 51.7. Productivity revised at 0.3% versus minus 4.1%. Import prices ticked lower as well, minus 1.2% versus minus 1%. Export prices was also lower at minus 0.8, higher at minus 0.8% versus minus 1.6%. And the PPI year on year, or the producer price index, was at 8.5% versus 8.7%. So all in all, you've got a mixed picture, with some areas seeing a slight increase in an inflationary environment, some of the other areas seeing a moderation or a slight decline. So what does that mean for the CPI report? Well, it depends on how we'll look at how strong, the direction is, whether we see an uplift again in inflation, or if we see a decline in inflation. But that should, and you can take that however you want and kind of make your own judgment as to what you think the inflation report is going to be. So the triggers then for the economic release. So according to economists then, what are they looking at? So they're expecting the highest estimate that they expect the CPI month-on-month print to be at spot 8% versus the low of spot 4%. Year-on-year with a high estimate of 8.1% with a low estimate of 7.7%. The core month-on-month high with a high estimate of spot 8% versus a low of spot 3%. And the core year-on-year with a high estimate of 6.7% and a low of 6.4%. Now, generally, when we look at the deviations and what we've seen in the past, when there's been at least a 0.2 deviation on all of the figures in one direction, like the last time we had it we had seen an increase in the CPI reports. Most of the figures had seen an increase. A couple of the figures had seen a 0.2% increase. Then we see a very strong reaction from the markets, where we'd seen, if we were looking at the triggers here, actually not the triggers, if we look at the deviation, I'll bring it up here. By the way, this is a free thing to subscribers only, that they have a chance to have a look at the deviations for how markets react to an economic release. So here you'd seen probably the biggest reaction we had seen so far this year from the NQ app. You had seen about 1,480 ticks down after all the bits of data were much higher than expected. You didn't see any moderation. You didn't see any decline. You'd also, on the S&P, seen 363 ticks down. Remember, the brackets represents the trading after 10 minutes, right? And how much did it move after 10 minutes from the initial release? Okay, and that goes to where the candle ends. The initial one here shows what the initial move was, going to the wick of the candle to try and capture how big the initial move was. And then on the you can see here on the Dow, we'd seen about 577 ticks down. Of course, currencies wise, not as big of a reaction compared to what we'd seen in the past for some of the currency pairs. You can see here there was about 95 or nearly 96 pips down on cable after that. If we're going back to September 13th, where everything was much higher than expected, and then after about 10 minutes of trading, it was still down by 139.6 pips. And also, but then later on in the next report, it was down by 75 pips, but was still, after about 10 minutes of trading, down 82 or 83 pips. So the biggest reactors were, of course, if I kind of scroll across, we don't want to miss the other ones. The biggest reactions you'd seen in the last report was on the Aussie dollar, on the Euro dollar, dollar CAD, and cable. Okay, dollar yen had usually seen a nice reaction beforehand, but this is the point where the Japanese were intervening in the market, so you didn't see too much of a reaction. Now that there's less of we don't really see the Japanese intervening in the market that much with their currency to try and stabilize the yen in the FX market. With the other economic releases like non-farm payrolls, where if I kind of go back, I'm going to find that here. Let's see. There we go. So yeah, with the other releases like non-farm payrolls, of course, still an important release. You're seeing more of a normal reaction rather than more of a constrained reaction or an odd reaction, which we'd seen back here, right, when the Japanese were kind of hitting hard with their intervention. So what that means is that we could see more of a normal reaction from the yen or the dollar yen today compared to what we've seen in the past when the Japanese were intervening. So that's the deviations there for the economic release. As I said, that is a free part of the macOS service. So if you are subscribed to the mailing list, you do get that for free. Okay, so I'll put in the link here for you. There for you to look at the link. That's there. Posted in the chat. So if you sign up to that, not only do you get the deviations for the upcoming economic releases that we will be covering for the week, but you also get the short rundown or a brief rundown of what to expect for the week ahead in the Asia session, US and European session as well, and a short summary of the weekend news as well. All right, so that's the triggers there then, and so we're expecting at least a 0.2 deviation on all of the figures to see, or at least on all of the figures to see a very decent reaction, or what we have seen in the past is for inflation to either see a 0.1% move up, at least on every single one of them, to see a decent reaction, or either way, either up or down. So the sentiment then, on the 7th of November, we see how the markets, according to ING analysts, that they're mostly pricing in the possibility of a split in Congress. So that was one of the prevailing factors for the markets at the beginning of the week, is that you had whether the Republicans will have a sweeping victory in the House and the Senate. Of course, they didn't. It's more of a split in the House and Senate. And that the sentiment was that if the Republicans had won, then that would mean that there would be, you would have a hamstrung administration unable to deliver fiscal support in a downturn. So that was one thing that was a risk to the US currency. But of course, if you're more Republican leaning, then you're opting for more deregulation, more support to, or allowing businesses to have more support, maybe through tax reductions, those sort of things that traders were kind of hoping for, businesses were. So that's why you'd seen a very choppy reaction, where you'd seen the S&P 500 see significant amount of downside movement, because there's more or less, you more or less got a split in Congress. So that was one thing as part of the sentiment that we had this week, or the prevailing sentiment that we had this week. That's kind of petered off a little bit now. You have had issues with FTX that has and Binance that had affected the risk-on sentiment in the markets, or had affected the risk-on sentiment in the markets, where you had seen FTX being, Binance maybe jumping in to help, to buy some FTX shares, and then you've seen Bitcoin fly, but then you see headlines where Binance says they might not be able to, and then Cathie Wood jumps in, and then it becomes a very big old mess in the crypto market, which can have a bit of a, have an effect on the rest of the market too, and how they kind of react to this news and this volatility that is being experienced within the markets. So Fed's Powell, November 2nd, rise. And then if we do not tighten enough, inflation may become entrenched. While short-term inflation expectations have risen since the last meeting, we do not believe they are indicative. The ultimate level of rates will be higher than previously expected. Then also some other views as well. So 7th of November, Credit Agricole said that for the time being, the dollar may struggle against a backdrop of recovering sentiment. That was according to Valentin Marinov, the head of G10 of FX strategy at Credit Agricole. I said, however, the biggest test of current market status quo could be another strong US inflation print today, which could reignite the rally in US Treasury yields and thus give the US dollar a boost. 4th of November, he had Goldman Sachs saying that we were talking about hiking cycles, and on average, a G10 hiking cycle lasts for just over 15 months, with 70% of cycles lasting longer than a year. So also from Goldman Sachs, in a research piece that I put out on October 31st as well, they said that policymakers tend to stop hiking when year-on-year inflation is still relatively close to its peak, rather than waiting for it to fall significantly. So this is one thing that was quite interesting. Historically, when inflation's been at or near peak, that the central bank, if they start to see that peeling off and they don't see a rebound towards the peak, Then they kind of pause and take a little bit of a breather or slow down with their rate hiking path. So that's what something that a lot of traders are kind of worrying that is the central bank or think about is the central bank going to pause earlier than expected with their rate hiking cycle. We'll get to an image on that from Goldman Sachs. So Barclays says that the Fed is not concerned about over tightening and the terminal rate pricing of 5.1% does not appear high given where inflation is or is forecast to be. So this is something from Goldman Sachs in their research piece, right? So month 0 represents where they pause their hiking cycle, and this represents inflation or the amount of movement that there is for the headline inflation and the core CPI. So you can see that inflation starts to, in the last hiking cycle that the central bank was in, or central banks were in, overall, if you're looking in the US, that's where they paused and inflation starts to peel down and go down by itself without having to do, but just keeping rates where they are, right? Or not hiking anymore. So could we be in for the Federal Reserve later on early next year? Or maybe could there be something in the December report, December meeting? Maybe. But I think we might be dreaming a little bit too much if we're thinking about December where the Fed could pause with their rate hiking path, considering if they go from 75 to 50 or they do 75 and pause altogether, it seems a bit too preemptive from what they've said in the past with pausing too early. So then there's also market pricing too. So you had November 2nd post the FOMC Fed swaps downgrade the likelihood of a 75 base point rate hike in December, and then post non-farm payrolls on November 4th, you had Fed swaps pricing the peak policy rate of 5.25% in June 2020 or by June 2023. So it had gone from about 5% to 5.25% post non-farm payrolls with the Fed swap. So that's just showing you that the markets are, expecting, although they're expecting a smaller hike in December, they are still expecting a higher terminal rate because Fed's Powell had, of course, said that they would probably see expect a higher terminal rate than they had expected. So, of course, it doesn't mean that they're finished with the rate hiking cycle then. With the Fed. So here's the investment banks then. What do they see? Right, so year on year, Citi, see for the CPI report, 7.9% as the JP Morgan, and Goldman Sachs and Bank of America see 7.8% for the actual figure, right? A month-on-month estimate, Citi and JP Morgan is spot 6, and Goldman Sachs and Bank of America spot 5. Don't forget, of course, the estimates or the median estimate is 7.9% for the year on year, 0.6% for the month on month. So both figures, so actually the CPI year on year is out of the two is expected to decline, whereas the CPI month on month is expected to see a 0.2% increase. Okay. As the expectation. Then the core estimates is also going to be quite key as well to the markets. So Citi sees 6.5%, as does Goldman Sachs, JP Morgan and Bank of America sees 6.4%. And the core estimates month to month, Citi, and actually all of these here, Citi, JP Morgan, Goldman Sachs and Bank of America all see spot 4% for the month to month read. So the current median estimate for the core month to month is spot 5%. And as I said, usually a 0.2% deviation from what we've seen in the past can cause a very big move in the markets. But seeing how sensitive the markets are to the CPI report, if you do get everything, even a 0.1% higher than expected for all the bits of data, you will still see quite a strong reaction to that report. Or even if you see a 0.1% deviation to the downside, you could probably still see a very big reaction happening in the markets. If the data is in line as expected, right, that's the key point. What if you get mixed data or data as expected? Well, when we've seen that in the past, usually, well, this is going back to March the 10th now. Okay, so we'd seen. Here we go. Let me bring it up here. That's what we'd seen March 10th, and when data was in line with as expected, you didn't see too much. You didn't see deviation at all with the forecast. You'd seen a positive move towards the upside on the on the stocks, and a move towards the downside on the dollar, although it wasn't that much back then. But that's one, I guess, one scenario to be aware of is that if data is in line with expectation and you're not seeing too much of a movement, you could see more of a whipsaw reaction, unless you have one of the bits of data that goes higher or lower than expected. So there's a lot to be aware of, a lot to be careful about how it's going to affect the wider market as well. Because remember, the CPI report, you will have traders starting to price in maybe a higher. If we look at the previous release then, what we had done, what we'd seen. So this is about 10 seconds before the previous release that we'd seen back on October 13th. And we'll look at the market reaction. We've got about 4 minutes left till the release. Okay, so data come out. So both bits of data had come out. You had seen that move towards the downside on the S&P, movement towards the upside on the dollar yen. Bond prices had also headed lower as well. Remember, the bond yields would go higher. So that's also one thing to be aware of there as well. Of course, bonds are going to be very key to how the markets kind of where they expect the interest rates to go. But that was the reaction there. So it dropped. The S&P tanked after that data. Again, you don't really see here, there's a 0.1% deviation on the CPI year-on-year figure. It wasn't that much, but all the data was higher than expected, right? So if you do get more of a mixed report, you could see the opposite reaction, or a bit of a confused reaction as to whether that's enough for the Fed to say, okay, we'll stick with a 50, or do we need to go with a 75? So that's one thing to be aware of. Or you could the market could take it that because you're having some parts of inflation heading lower, that could be enough to stick with a 50, and the Fed doesn't need to do that much. If you don't see big deviation or no deviation at all, and you might see the S&P and bond prices going up instead, and yields heading lower with the dollar heading lower too. So those are the different scenarios that are presented. We've got about 2 minutes left to the release. So if I kind of skip forward and kind of see how the markets were. Yeah, it was still down. All right. Got about a minute or about a minute left till the economic release. I need to get my Tickstrike up and running. So I've got the dollar yen here. We got S&P. We've got bond prices, of the 2-year bond prices, 2-year bond futures there, up and running. Let's get Tickstrike running too. Right, less than a minute. Let's see what this baby does. Okay. Tickstrike's all set. Whew. All right. Either it smashes it, or it crashes it. All right. It's 15 seconds. Okay, 10 seconds. Okay, 0.4%, 0.4%, lower than the forecast of 0.6%. CPI year-on-year 7.7%, 7.7%, lower than the forecast of 7.9%. So, lower than expected inflation print. Whoa! S&P crushing it. Hell yeah! Look at that. Okay. So, all that there. So CPI year on year at 7.7% versus the forecast of 7.9%. Lower than expected. CPI month on month 0.4%, lower than the forecast of 0.6%. Core CPI year on year 6.3%, lower than the forecast of 6.5%, and core CPI month on month 0.3%, lower than the forecast of 0.5% as well. All right, so apologies if you were not able to see the headlines appear for the on the website. We have a lot of people that jumped on all at one time on the website, so that crashed the website. We've become very popular for economic releases because we're so fast with it. Somebody said, "Tony, are you okay?" Billy said, "Fell off his chair." No, just trying to manage the site as best as we can. Again, as said, we were because there are so many people joining the site at one point at one time. That caused the site to crash. But hey, we've seen the market reaction nicely, right? And hopefully, apologies for any issues that you had. So that's 382 ticks towards the upside. Carry on like nothing happened, Tony. It's all good. Right. Let's look at the Dow. See what we had there. 610 towards the upside. Nasdaq. What we got? Wow. Ooh, is that the biggest reaction we've had from the NQ? I think it is. Yes, it is. From since I'd reported it from February 10th. Yeah, that's the biggest move on the NQ that I've seen. That's 1,520 ticks towards the upside. That's beautiful. Huh? Let's look at the dollar yen. Let's get the currencies in. Okay, that looks 140 something. Okay, 124 pips down. There we go. Okay, look, there we go. Fed swaps downgrade 75 base point rate hike in December. So more or less pricing in for a 50. The December meeting. These are very, very big moves here. That's 122 pips towards the upside on cable. Euro dollar probably is similar amount, similar move too. Everything, love that. Well, everything other than the dollar and bond yields. Okay, let's go. That's 104 pips towards the upside. Let's look at the bond prices. Gold is of course flying. Bond price. Look at the 2-year bonds. Okay, that's 101 ticks towards the upside for the bond prices. So the yield is gone down. Gold. That's 228. I think that's also the biggest reaction. Nope. It's not the biggest reaction from gold from report. Actually, you know what? It's very close. The last report that we had, you'd seen 229 ticks down on gold. Today we've seen 228 ticks up on gold here. Ooh. All right. So, don't forget. Of course, we've got Tickstrike running in the background here as well. As in, apologies if you did look at the website and you didn't see the breaking banner come up for you, the headlines come through. Because we're so popular and because so many people joined at one point, that's why the site crashed. If you do have that, yes, WTI did also go up as well. Let's grab that up on the screen. Why not? Let's grab that on here. Here we go. There we go. WTI. Dang. All right, it's 128 ticks towards the upside there on there we go. Okay. All right. So, Tickstrike. Let's go through some other things. So again, as said, for the deviations, if you want that data for the deviations, as said, that is for free, right? All this. So what are the deviations, right? What does this all mean? So the deviations just show you how strong or how big the reaction was to an economic release on the different assets that we have here. Okay, particularly for the big US releases like the FMC that we had. Not too long ago. Let me whoops. Let me close Tickstrike for now. Okay, that was the FMC rate decision. Then you have the deviations of how big of a reaction there was within the markets. The sentiment as well listed for what had caused the market move, why the markets had reacted in a certain way as well. That's also listed as well for the mainly that's listed for the interest rate decisions, not for the economic releases or like figures, because the sentiment is already kind of in play beforehand. But when you're looking at the central bank statement or press conference or the meeting minutes that are included together with the statement for the Bank of England, as an example, then that will shift sentiment depending on what's been said and what decision or why the decision was taken in a certain direction. So that's all also included too in the deviations that we have. Remember, it's sent to you once a week on a Sunday. It's for free. It doesn't. You get a brief rundown of what to expect for the week ahead in the Asia, US, and EU session as well, as alongside with the summary of weekend news and then the upcoming live streams for the week ahead as well. But again, if you are interested in looking at that, I know I've had quite a bit of demand for people saying, "Hey, is it free? Can I please have the secret sauce?" Yeah, sure. Just ask or sign up to the Macrace mailing list, and you'll be able to get that without having to ask all the time. All right, so that's the deviations there. Now, of course, Tickstrike, which I just had up, I'll get it back up and running. Now, Tickstrike is very useful, particularly if you're a day trader or scalping the markets. It's what it does is it measures the amount of order flow that there is, right? And or in another way, you can say how strong the buying or selling momentum is within a certain asset or asset classes, whatever you want to look at. Tickstrike, if I bring it up here we go. So you've got Forex, you've got crypto. They can, measure order flow, futures, stocks, ETFs and ETNs, and internals as well, like your VIX. You can also keep an eye on how strong there is, how strong of a momentum is there with the VIX and other stuff as well. So if you don't know what Tickstrike is and you're looking at this, what we call a ticker or this box here. So what Tickstrike is, okay, what this represents here, The plus sign represents the buying momentum that you see within an asset class or assets. Okay, and the negative or the minus symbol represents the selling that's going on. So if you see so then your next question is, what's this 1, 5, 6, 10, or 8 that I see here? What does that mean? So on the ticker box here, there's a slidey button, okay, that changes the level of sensitivity. Okay, so level 1 is the most sensitive to market reactions, meaning if there's a little bit of buying or selling that's going on within the market, as you can kind of see here, then Tickstrike will go off. Okay, but if you want to see when there's a big amount of momentum that's happening within asset class or asset classes, then you can increase that level all the way to 15, which is the least sensitive to market reactions. And only when there's a big market reaction that's occurring, then only then will you see Tickstrike give you an alert as to what's kind of going on visually and audibly as well. I've got the sound turned off at the moment because otherwise you'll hear Tickstrike constantly going off. But you can also get an audio. You can also have audio too. But again, key thing is, particularly for you guys who are day trading, and you're scalping the markets or whatever it may be, then it's very useful for that there as well. Of course, kind of have a play with how you want to use it, whatever kind of works for you. But of course, we'll put the link here for the 7-day free trial for Tickstrike. That is there in the feed. Also, we have unusual activity, which we've brought out as a new product, a new service that's being provided. So if you like trading unusual volume activity in stocks, also crypto, forex, and futures, then you can join the free beta test group of the new service. Okay, with the link here. That's here, and that's also in the chat for you there. Other than that, that basically concludes macro race for the week. There isn't anything else really. Of course, don't forget to give us as I said, don't forget to like the video, share it with your fellow traders and friends, and also don't forget to subscribe to the channel as well. But as you can also give us a like or follow us on Twitter as well. All right, we had a load of comments coming through. Farhan Chaudhary said, I had a question. Some news are red and SPY shoots the moon, and some news are green and it drops hard. Could you kindly explain that in short words? Okay. If the market is expecting, if you get, I'm trying to figure it out. Inflation is bad. Okay. Less inflation is better for the stock market. Well, small inflation is better for the stock market, meaning the central bank will hike by a smaller amount, which is what traders were starting to price in. Higher inflation, okay, is bad for stocks. Okay, that will lead to an expectation for central bank to raise rates by a lot. On default, of course, this is based on what whether it's good or bad for the currency. Okay, for the US dollar. So red, of course, means that it's worse for the US dollar. It doesn't. It's not showing you whether it's good or bad for the stocks or for the stock market. That's how it's done on here. Of course, what you can do if you sign up to the pro version, of course, if you are looking to kind of make that easier for you to kind of trade, or give you make it clearer for you to kind of trade. So the CPI month to month or year on year, you can put in your own triggers for the economic release. Okay, so you can say if the actual is greater than such and such. This is just a forecast, so that's not us telling you what to do. You can put in your own triggers to make it easier for you. So if you said, if inflation was much higher than expected, then you could expect inflation to be much higher than expected. You could you put in the send alert saying if the actual is greater than, I don't know, 7, let's say 8%. Okay, you can do that, or buy alert. You can do, say whether the actual, if the actual is less than expected, it's 7.7, which it was today. Then you can do that. Of course, you can chop and change, but default it's based on what the currency is, how it would affect the currency for the market. Okay, does that kind of answer your question? Oh, I don't know if the dude's gone. All right. I think. Oh no, William Riker gave your answer there. That looks. Huh? Sounds like an alarm is going off in the back. Let's kind of hear it. I didn't hear an alarm. Unless you put the sound on very, very high. Okay. Anyway, that concludes the live stream for Macro Race. Hopefully you found it useful. Don't forget to, as said, like, share, and subscribe to the channel. Give me your feedback as well. And I will speak to you guys later. All right. Take care.